43% of people Affirm lends to are subprime, which is 2 times more than that of Capital One, one of the biggest lenders in America. Yet, Capital One's delinquencies are 32% higher than that of Affirm. So how is it possible that borrowers who are supposed to be weaker are less delinquent when it comes to Affirm? And also, how do I know that this is Capital One? Well, if we go to the notes section, we see that the 3 lenders in which are being compared to Affirm are Bread Financial, Capital One, and Synchrony Financial. We see that 27% are the non-prime receivables. We go here, we see that 660 or below, which is going to represent credit score, is going to be 27%, which exactly lines up with 27% here. And then since we have two 27% figures, we just go find the 3.7% for the domestic credit card delinquency rate. And we find that issuer C is Capital One, and the other 2 lenders are even beyond that in delinquencies. So how is Affirm able to outpace the other firms in terms of delinquencies? Well, first off, there's obviously the structural difference, which is issuer C, or Capital One, is using credit cards, while Affirm is using point of sale loans, which are much simpler in nature than that of credit cards. Credit cards are extremely complicated for most consumers because you have compounding interest, late fees, and minimum payments, to the point where you don't actually really know exactly how much you should be paying back. When you have a minimum payment, you're tempted to just make that minimum payment and your balance just keeps on compounding to a point where you're just not able to pay your money back. Affirm is completely different. You have a set schedule, you don't have late fees, and the interest is simple interest, meaning that it's not going to be compounding against you throughout the life of the loan, making it a lot easier for borrowers to understand how they're supposed to be paying back this loan. People who historically haven't been performing well on loans need this structure in order to be able to pay them back easier. It's a very smart idea that allows for better repayments into the long term for these people who may have struggled in the past. And this really is one of the core ideas of Affirm. This is from the Q3 2026 earnings call. On the consumer side, we're not really heavy advertisers, certainly not heavy brand advertisers, yet we do have a brand. And in 15 years, we say no to late fees, and we mean it, never charged a penny, don't plan to ever charge a penny of late fees. That's slowly but surely building up in our favor. Affirm is able to build a brand by not charging fees. So consumers understand in the long term that they're not going to be paying these fees that they would be paying on the credit card balances. And this, in the long term, slowly shifts consumers more towards an Affirm product to be lending from. For these credit card companies, when you issue the card, you do that main underwriting right when you issue the card. And then throughout the length of the card, the person is able to buy whenever and wherever they want. This is completely different for Affirm. Affirm has a structurally different product where each time you want to make a purchase, Affirm is going to underwrite that transaction, which leads to stronger performance for Affirm. Max really prides Affirm on their underwriting capabilities. As you can see, we have built some very, very sophisticated underwriting capabilities. This seems to be the main moat that Max is arguing for the company. And the proof is here. If you look at Capital One, the net charge-off rate for the credit card business is 5.05% for 2026, the 3 months ended March 31st. And then if we go to Affirm, we see that the loans in Q1 2026, the ones seasoning, are seasoning with the rest of the cohorts, which were earlier, and these cohorts were tracking towards approximately 3.5% ultimate net charge-offs as they seasoned. So clearly, the Affirm loans are doing better than the Capital One loans. And I think this remains one of the largest points in fintech. We're offering new products to consumers in the realm of loans. And it appears that consumers are able to fare better with these loans, which means both Affirm is protected and the consumer is also protected. One last idea that I want to go to, which is not completely obvious when you first look at it, is how well Affirm has been able to maintain this delinquency curve. If you look at the other curves, you see that they have a general trend down, or maybe even a little bit flat, but mostly it's down. Affirm, it appears that it's a little up, if not flat. Now, that would suggest that maybe Affirm isn't doing as well as the other companies in terms of the macro that we are experiencing, but I would argue otherwise because Affirm is growing extremely quickly. As you can see, they're in these mid-double-digit growth rates, and the growth of the top line is very, very fast. Now, when you look at the fact Affirm is growing so quickly and then compare it with the fact that they're able to keep delinquencies relatively flat, it is actually astounding. Affirm is not sacrificing credit quality for the ability to grow. It shows that consumers are actually moving from the old realm of credit and then moving into this new realm of fintech credit. And once again, it brings up my argument that maybe we have a better product here with fintech. But it feels like the market disagrees with us that fintech has better products. We saw a lot of fintech companies come in between 2020 and 2022 when rates were near zero. This was the best time to raise capital as valuations were sky high. But when the rates started to increase, those valuations naturally dropped, leading to some difficulties for some of these companies. So it begs the question, are these new fintech lenders able to handle these larger macro risks? But I argue they're even better off than some of the most established lenders in the world. And the reason for this is a lot of these lenders are giving really short duration loans. We see point of sale loans that last from 6 to maybe 24 months. We have an average around 11 months, meaning that the book is going to be turning once a year. Compare that to pretty much any other bank, and you're going to have loans that are going to be lasting many more years than that, sometimes dozens of years. Books that are much longer to turn over than that of Affirm. I think that this is a structural advantage that most fintech companies have, and I think that's going to give fintech the advantage into the long term.